Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand not only what we see in the global landscape, but how we're currently positioned. Within all of our global tactical opportunity portfolios for clients, we did exit out of the base commodity and we actually re-entered our trade into gold. Ultimately, the moves by Ben Bernanke and the central banks around the world are starting to show that gold is actually relatively stronger than the base commodities. And even though the base commodities does own a small position of gold, I'd rather opt for a bigger position in gold in all of our client accounts. So we did add that within client portfolios. We also exited out of the Eurozone basically, and we added more back into emerging markets. Emerging markets have greatly underperformed a lot of the other base indexes around the world this year, but it's starting to come back on a relative strength basis. So we're essentially buying it cheap, and we think it will ultimately get stronger as the year turns out. The overall economy in the U.S. is showing areas of improvement and stabilization. Not that we're off to the races, but these are positives. Ultimately, what the government is trying to do, Ben Bernanke, if you think about this, they're essentially trying to create inflation or reinflate the economy. Not only here, but the central banks around the world are doing the exact same thing. Let me explain what that means. They're bringing interest rates to all-time lows. They are going to obviously borrow money at the cheapest rates in history for themselves to pay debt over the next 30 years. So ultimately what's going to happen is rates come down to 2.5%, let's say in the 30-year. The government issues bonds and essentially pays those debts over a long period of time at the cheapest rates in history. And what you're doing now is you reinflate your way out of it. Essentially what happens is inflation is going to run, let's say, an average of 3%. Well, if they're borrowing rates at 2.5% and inflation's 3%, in about 5, 6, 7 years, the interest cost in theory is about half of what it's costing as you inflate the economy and the economy's grow 3% a year. So ultimately, this is going to help the U.S. economy get itself out of debt and reinflate asset prices and reinflate the consumer and spending. And I believe the same thing is going to happen around the world. While we may still have a recession a year down the road or 6 years or 16 years down the road, our system will be adaptive. Our global tactical opportunity, remember folks, we make adjustments when necessary. So if you see a few more changes in your portfolio month by month, it's because our strategy leads us to the strongest sectors and also reduces risk in severe down markets. So far year to date, our global tactical growth is lagging the base index of the S&P because we took a lot of risk off the table because our strategy dictated that back in kind of that July time frame, only to see the markets rocket back up almost 8 or 10%. So we missed out on a big part of that rally. I'm willing to give up a little bit of a rally over the short term in order to basically protect against severe downturns in client portfolios. That's what our system is designed to do. Reduce risk on severe downturns and also capture the long-term upside of all the various sectors around the world. Remember, our portfolio can go anywhere. We can be in cash, we could be in inverse or short the market, any kind of bond, commodities, gold, you name it, we can be in really almost any sector. And by having that flexibility and following that strategy, what we find is our relative strength strategy works exceptionally well at reducing severe risk and actually increasing net return over time. So with the U.S. economy stabilizing and looking like a couple points are getting just a tad better, Europe is definitely in a big recession. Emerging markets have slowed down, but I think that they're starting to trough, and ultimately I believe emerging markets will probably lead the economies higher, and I believe hopefully as we get into next year, we'll see a little bit more lift in our U.S. economy. I believe we're positioned well. As I made a comment, we have made some adjustments within our global tactical portfolio. That's what you have to do. You have to follow strategy. Ultimately, I think the last quarter of this year potentially could be pretty good. It's going to surprise some folks. We'll keep an eye on things. We'll make changes as necessary. If you're a client and you have a question about your portfolio, please call the office. If you're not a client and want to become a client, call our office for a consultation. There is a difference. We invite you to experience it. Until next Sunday's show, make sure you have yourself a safe and profitable week.